December 3rd, 2024. A single piece of paper landed on a desk at J.P. Morgan Chase. A delivery notice. 5.2 million ounces of physical silver. Sounds routine, right? Wrong. This was the moment America's biggest bank realized they were trapped in a scheme they spent 15 years building. And the math? It's absolutely brutal. Because here's what nobody's talking about. They promised to deliver almost 1 billion ounces of silver. They have 28 million ounces available. Do the math with me real quick. That's 30 paper promises for every single ounce of actual metal. Welcome to the greatest financial trap of the decade, and it's closing fast. The paper game. Let me show you how this scam actually works. When you or I think about commodities markets, we picture real stuff getting traded. Barrels of oil, bushels of wheat, bars of silver. But here's the dirty secret that Wall Street doesn't want you to know. 95% of silver futures contracts never touch physical metal. They settle in cash. People take their profit or loss in dollars and walk away. The metal never moves. Think about what that means for a second. If only 5 out of every 100 contracts actually need real silver, you could theoretically sell 100 paper contracts backed by just 5 ounces sitting in a vault. It's fractional reserve banking, but for precious metals. You promise everyone delivery, knowing almost nobody will actually show up to collect. And for decades, this worked perfectly. Enter J.P. Morgan. Between 2010 and 2020, they didn't just play this game, they dominated it. They became the single largest vault operator on the COMEX exchange. Why would the biggest bank in America want to run warehouses full of silver bars? Control the vaults, control the game. When someone actually demanded physical metal, J.P. Morgan could shuffle inventory between categories, creating the appearance of abundant supply without sourcing new metal. Brilliant, profitable, and according to the Department of Justice, completely illegal. September 2020. J.P. Morgan paid $920 million to settle charges of market manipulation, the largest precious metals fine in American history. The charge, spoofing, placing fake orders to manipulate prices, then canceling them before execution, $920 million. And they didn't even have to admit wrongdoing. They paid what amounts to a parking ticket for a bank their size and kept playing the exact same game. The rules changed, but then something happened that changed everything, and most people have no idea it even occurred. June 2021. Basel III international banking regulations went into effect. Buried in those updates was a technical classification that sounds boring until you understand what it actually does. Unallocated precious metals got reclassified from Tier 1 assets to Tier 3 assets. Translation? Banks can no longer count paper metal promises as high-quality assets. If you're holding a derivative position promising silver delivery, you now need actual physical metal backing it, thus not just another paper contract. The fractional reserve game just got shut down by international banking law. No press releases, no dramatic announcements, just a regulatory footnote that made the old manipulation strategy mathematically impossible to continue. And here's the beautiful irony. This isn't some COMEX rule that can be suspended during a crisis. This is international banking law. Violating Basel III means violating global banking compliance standards, the kind of violation that triggers consequences way beyond just getting fined. Remember what happened in 1980. The Hunt brothers accumulated 59 million ounces of physical silver and nearly broke the market. Silver went from $6 to $49.45. The COMEX literally changed the rules mid-game to stop them. They implemented Silver Rule 7, which banned new long positions. The Hunt brothers were bankrupted. The short sellers were saved. But here's the trap for regulators today. They can't just implement Silver Rule 7 version 2 because Basel III supersedes COMEX bylaws. They can't change these rules without triggering an international banking crisis. The precedent says, protect the shorts, but the regulatory structure says you can't. So why is this exploding right now? Why $59 per ounce specifically? 3 pressure points hit simultaneously, and each one makes the situation exponentially worse. Pressure point 1. Mining supply. Withholding. At $58.50, silver production becomes profitable enough that major producers made a calculated decision. Instead of delivering their newly mined silver into COMEX warehouses at exchange prices, they started selling directly to industrial buyers at premium prices. Why feed the exchange that's been suppressing your product's value when manufacturers will pay more for guaranteed supply? Pressure point 2. Asian arbitrage. The Shanghai Gold Exchange saw silver prices hit the equivalent of $62 in yuan terms during November. That created a $3 arbitrage opportunity. Buy silver from COMEX warehouses at 59, ship it to Shanghai, sell it for 62. Simple math. COMEX inventory dropped by 4.1 million ounces in November alone as metal flowed east. Pressure. Point 3. Industrial panic. Buying, this is the big one. Solar panel manufacturers, electronics companies, electric vehicle producers. These companies need silver for actual production. When silver crosses $59, it triggers panic in procurement departments because this price signals potential shortage conditions ahead. Imagine you're responsible for sourcing 10 million ounces for your company's solar panel production line. Your entire manufacturing schedule depends on that material arriving. At $58, you might wait. At $59, you stop waiting and start panic buying. Because the cost of missing production targets far exceeds the cost of paying a premium for metal. These industrial buyers just stop being the exit liquidity that paper traders relied on. Let me show you the numbers that prove this is unavoidable. Total COMEX registered silver inventory, 28.4 million ounces. That's metal actually available for delivery. Total open interest across all COMEX silver contracts, 862 million ounces. That's a 30-to-1 ratio. 30 paper claims for every physical ounce. Now, remember that 95% historically settle in cash? Let's run a simple calculation. What happens if just 3.5% of open interest demands physical delivery? 3.5% of 862 million ounces equals 30.2 million ounces. Available registered inventory equals 28.4 million ounces. We're already in deficit territory, and we haven't even reached the normal historical delivery rate yet. JP Morgan received delivery notices for 5.2 million ounces in December alone. If that rate continues, the entire registered inventory gets depleted in 5.4 months. We're looking at May 2025 as the mathematical endpoint where deliverable silver simply runs out. But here's where it gets worse. Delivery demands accelerate as inventory drops. Why? Because once people realize inventory is depleting faster than it can be replenished, the rational response is to demand delivery immediately. It's a bank run, except the bank is a vault, and the deposits are silver bars. Can new supply rescue this? Let's look at the data. Industrial silver demand for 2025, 642 million ounces. Solar panels alone require 247 million ounces. Electric vehicles need another 15 to 25 million ounces of new demand. Global mine supply, 843 million ounces. That leaves a surplus of 201 million ounces. But here's the problem. That surplus used to be 340 million ounces back in 2020. It's shrinking every year, and miners are now selling directly to industrial users at premiums rather than feeding COMEX warehouses. The supply can't save them. So how high does this go? Let's look at historical squeeze patterns. The Volkswagen short squeeze in 2008 happened in 3 stages. A gradual 300% gain over 2 years, a pause while shorts attempted to cover, then a vertical spike of 380% in 48 hours. Silver already completed stage 1, from $18 in 2020 to $59 today. That's a 327% gain. We're entering stage 2 right now. JP Morgan's forced deliveries represent their attempt to cover before this becomes uncontrollable. Stage 3 triggers when registered inventory drops below 10 million ounces. Based on current delivery rates, that's 3 to 5 months away. Here are the price targets. Conservative scenario: $120 to $150 per ounce, based on the gold-to-silver ratio returning to its historical average. Moderate scenario: $200 to $250 per ounce, equivalent to the 1980 peak adjusted for inflation, plus a premium for today's higher industrial demand. Vertical spike scenario: $295 to $350 per ounce. This is what happens when industrial supply chains panic. When a procurement manager faces shutting down a billion-dollar production line versus paying $300 per ounce, they pay $300. Timeline: second quarter to third quarter 2025. Somewhere between 6 and 9 months from right now. This is not prediction. This is calculation. The inventory numbers are published by COMEX. The delivery demands are documented. Industrial demand projections come from the Silver Institute. JP Morgan's position changes are in their SEC filings. You're watching a mathematical trap close in slow motion. A 15-year scheme where the biggest bank in America promised to deliver almost 1 billion ounces of silver while holding less than 30 million ounces in available inventory. They can't win. They can't escape. And the clock is counting down. The only question left is, how high does silver go when everyone else figures out what the math has been screaming for months? Because at $59 per ounce, we're not at the end of this story. We're just getting started. If you found this breakdown valuable, subscribe to Finance Wealth Money for more deep dives into the stories Wall Street doesn't want you to see. Drop a comment with your silver price prediction for 2025, and check out the description for all the data sources and links. This is the biggest financial story nobody's talking about. Until now, stay wealthy, stay informed, and I'll see you in the next one.